Hi, good morning, everybody. Welcome back to another one of Foresight's Fireside Chats, where we talk about all the things that you might be interested in the clean tech space. As always, we have our wonderful moderator, James Chapea, who I think needs no introduction, but I will give him one anyways. James is an executive in residence at Foresight. He's previously worked with Zone Startups, Goldman Sachs. He's been a venture capitalist. He's just done everything in and around the financing space over the course of his career, and a wonderful asset that we have here today. We're also joined by Kai Alderson. You'll see him as the other name on the screen. Kai and I first crossed paths, gosh, what was it, about 2 years ago, talking about carbon credits. And since then, the carbon credit space has just got so much more exciting after a couple iterations of, well, one iteration of the kind of COP that's moving towards more international trading, lots of projects, lots of noise in that space. And here he is today to talk about environmental, social, and governance aspects of businesses. Kai is a partner at Fasken's, one of Canada's largest law firms, if you're not aware of them, and he's an energy and natural resource law specialist and works on all climate-related matters. He's also part of Fasken's ESG steering committee, which is kind of, I think, the experience and knowledge that he'll be leaning on in today's session, which will be, as always, moderated by James. Before I turn the mic over to these two fantastic folks, I would like to mention that today we launched our nominations for our Foresight 50. That'll be an event held at the end of November. This is for Canada's 50 most investable clean tech companies. If you know somebody who you think should be recognized on that list, please go and nominate them. You can find that. I believe Astrid will share that in the chat here. You can find that on our LinkedIn page, on our website, probably as many places as we could possibly put it. That's very exciting. And also our fall cohorts are coming up here. The application deadline is August 19th, which is just a few days away. If you know anybody who would like to participate in our programming or should participate in our programming and would benefit from it, please have them apply on our website. And if I'm lucky, Astrid might even put a link in there for that as well. Without further ado, I will turn it over to James.
Thanks, Stephen, and good morning, everyone. Welcome to another Fireside Chat. As always, just on the admin side, if you guys do have questions related to our topic of the day, please try and put them in our Q&A so we can actually address them. It makes it a little bit easier for us than if it goes in the chat for managing those Q&A stuff. But as we now, aside from that, let's now dig into what the heck is ESG. It is thrown around. This thing just keeps. Kai, I want to know, what's your ESG story? How did you get to actually deal with this? And you know, on that, what is it actually? Is this just another fancy name because we didn't want to talk about environmental, so we had to make an acronym for it? Let's get into first, what's your journey? How did you get here? How are you become an expert on this stuff? And maybe that'll help people with some of their questions, and we'll go from there.
Sure, sounds great. Thanks a lot, James, and thanks so much for everyone who's participating. I really appreciate the time you're taking and the opportunity to share some of my experience and then what I'm seeing in the market with all of you. So just my own personal history, we'll start there and go on to what the heck is this thing. Before I began my legal career, so my being a lawyer is my third, and my wife tells me final career choice. I was actually involved in what was then called the socially responsible investment industry and what has now blossomed as the ESG investing industry. So two of those acronyms right there that you're talking about, James, SRI and ESG, which I'll use interchangeably, but we can chat about later if there's a difference between them. I was involved in the ESG research side, so research on portfolio companies as well as shareholder engagement, proxy voting, shareholder activism. So I've actually seen quite a bit of the tools and techniques and practices and approaches that have now become mainstream. Back then, 15 years ago, it was kind of a niche thing off to the side. Now it's become mainstream, but not a lot has changed. What's changed are the attitudes, right? When I decided to leave the industry, become a lawyer. I thought that would be interesting. I could do all sorts of things as a lawyer that would be related. And I quickly was disabused of that kind of naive view. And so not my current law firm, but another law firm when I was applying, I remember the question in the interview was, so I see you work for ethical funds. You didn't actually believe all that stuff, did you? It was more of a job for you, right? And it was the only time in my career where answering, yes, it was just a job, and I didn't care about what I was doing, was the appropriate answer in a job interview. So I'd certainly say when I got into law, there was very little ESG related work other than the kind of environmental and, you know, there are a number of things that I ended up doing, renewable energy, carbon offsets, indigenous agreements, which are now broadly under the ESG rubric, but that really came later and is only in the last, I'd say, 2 to 5 years that this is a sustainable practice where companies are coming to lawyers for advice in these areas. So sorry.
Oh, go ahead.
I feel like I'm talking a lot, but I'll launch into what it means if you think that's the next place to go. Because I think from where I'm sitting, in terms of what my practice is and what I'm dealing with, you know, we can go back more than 50 years ago to Milton Friedman's essay on the social responsibility of businesses to increase profits. And at that stage, he said, you know, as long as you're playing within the rules of the game, pay your taxes, don't engage in fraud, don't engage in anti-competitive behavior, the one and only responsibility of corporations is to increase profit. And I think what we're seeing now is, and this is really what ESG is about, is companies are understanding that those rules of the game are not very stable. They're changing rapidly. Voluntary codes and voluntary initiatives can become law very quickly. And so participating in those kind of voluntary initiatives can be an investment in being able to track where their legal obligations will come soon. And consumers and employees are very interested in what companies are doing beyond the bottom line. So ESG is really about investors asking their investee companies, their portfolio companies, to mitigate and manage their social and environmental risks, put in place good governance practices to manage those risks. And it's also about, and this is where my practice is, helping profit maximizing companies to do just that. And how do they take those issues seriously in a careful, prudent, and business-like way?
So are you seeing a change in this? Because, you know, if you go back a little ways, when clean tech first became a thing and you saw capital flows going where you saw funds establishing clean tech investment sectors of it. And then, you know, that lasted for a little while. And then, well, you even take a look at the top six VC firms blew up their clean tech practices, like just totally shut it down. It was like, you're now got this conflict taking place between the ESG side and the return on capital, like you're saying on Friedman. Now you're saying that there is a movement that's taking place that tries to balance that, or is that lip service to it, or are you actually seeing that take place?
I think the more there is a difference, a distinction between folks who are more focused on the impact that companies have on the communities they operate in, on the environment, et cetera. So that's sort of one group of folks. They're the pure play, motivated by ESG factors, perhaps, mutual fund investors or employees who are very concerned about these impacts. And then I would also say there's a group of people who are focused on the business risks and how those trends and factors are impacting on companies. I put both of those in the category of ESG, and I don't think either of them are just paying lip service. Like, I don't think it's lip service for a company to say, this is now part of my business context. I have to understand what it means, how to respond, what I can do, and to apply all of my management tools to address these issues in a prudent, careful way. I don't see those as distinct. I think some people in the first camp would see folks in the second camp as paying lip service, but that's not how I would view things. I think most companies who are engaged in this are, sincerely trying to address these issues within a broader business context. And so they're not just responding willy-nilly to the demands, but trying to make careful investments, prudent investments in shifting their operations in the direction that's being demanded by the first camp. Does that make sense? Or
Yeah, no, it does make sense. But I'm gonna, before we actually tear apart ESG for a second, I want to get, because you're talking about capital flows, which is, I think, from a lot of our participants here, they're early stage companies, they're looking at capital raising. How does this play into the capital raising? Does it play in? You've got these different vehicles like B Corps and so forth taking place. Want to get your thoughts on capital for early stage companies relative to ESG, and how should our companies be looking at this?
Sure. So I think it's basically a matter of how you want the broadest possible tent that you can have when you're thinking about capital raising. There are increasingly funds, perhaps not as extensively in the venture space and early stage space as there are in sort of established mutual funds and investment managers who are directing funds or privileging investments in entities that can take seriously and demonstrate that they take seriously these issues. It's one factor amongst many. I'm not talking about people exclusively investing in these factors, but I think there are enough of them now, and there will be more soon, where it will make a difference in the pool of potential funders to be able to demonstrate that you're paying attention on these issues. So I think that's the critical perspective for the startup is let's make the list of potential funders as long as possible. And some of those, and I do believe I'm seeing more and more coming on stream, where being able to either be focused on environmental or social issues or demonstrate that you're taking that into account in your management approach is a factor.
Okay. I think that absolutely does make a ton of sense. The early stage does need to focus on their revenue and make sure that they can get access to capital. Otherwise, it really doesn't matter what they're going to do. If they cannot raise the capital, then it becomes a bit of a moot point. Maybe if we just step back for a second and say, okay, so why did we actually create this acronym, ESG? What are those points? Let's try and deal with this individually and holistically to say, okay, so if you're a social and responsible investor, are there different points on this, or are they all intertwined? So environmental, E, what does it mean for you?
So environmental is historically taking care of environmental externalities from the business, but I think increasingly you can think of it as sort of thematic. There are a few thematic points that are really emerging. Most of all, quite clearly, is climate change. So climate change and issues around climate change, corporate responses to climate change, energy use, intensity, et cetera, seems to be one of the most important sub-themes in that sector, I'd say. Biodiversity is coming right up behind and is something to pay attention to, especially for early stage or startup companies that are involved in agriculture or other areas where there might be a biodiversity story. There was going to be a big biodiversity push, sort of complementary to climate, it was all planned to take off, and then COVID hit. And so there's been a bit of a delay. But there is, you see in mining companies, you're seeing quite a few of the majors start to take a real serious look at how to build resiliency and how to build biodiversity within their zones of operation, not within the mine itself, obviously, but within the areas that they impact. And then water is another area where I've seen water use, water efficiency, water scarcity become a very important theme in the environmental category. And you can see with water that it's something that it is both something the company impacts and also can impact those revenue operations with drought, impacting beer companies or all sorts of things where there's a direct impact between water scarcity and business risk.
Right. So let's move to S.
S, so sure. S is sort of the social dimension, and it really has two areas to it. You're both looking at workplace practices, safety, health and safety type issues, diversity, equity, inclusion issues inside the company's workforce, and also looking at impact on the community. So you would put a lot of things under here, and very much depending on your operations as to whether you're talking about how you pay your taxes, to if you're a multinational mining company, how you're impacting the communities in which you operate. Supply chain is also a very important item in the S that might impact startup and early stage companies. If you are technology based and your supply chain includes countries where there are concerns about human rights or workplace matters, being able to trace and manage and at least explain where your materials are coming from is going to be increasingly important.
I totally agree with you. We're seeing that the geopolitics of the world, how it's changing, and it has impacted supply chain. So I wasn't actually even thinking of it from a social perspective, but I can see how it intertwines. So then from a G perspective, is this does it apply to early stage companies, or does it apply to everybody?
Well, I think it applies to everybody. The G is stands for governance. And I think traditionally governance was very much described as sort of classical corporate governance type issues. And how do you engineer your governance so as to appeal to shareholders? That's going to impact everybody. But within the ESG space, I think governance is increasingly being understood as governance around the E and the S. So you would put under this heading disclosure practices, whether the board has oversight, or specific committees or individuals have oversight over E and S issues focused on climate change, or whether management is trained, et cetera, in these specific issues. So it's sort of G of E&S, if I could put it that way. And then there are still some traditional issues around executive pay and whatnot, which continue to be very much in the ESG world, which are more traditional governance concerns.
So what I'm kind of hearing from you is that, so when we work with early stage companies, that we need to have this as part of our governance of them to make sure that this is top of mind, that they're at least being aware of what is going on from a maybe a risk management or a business opportunity perspective.
Yeah, I think that's right. Absolutely.
So it's not just a big company thing. This is like definitively it's an element that's going to be impacting everybody.
Yeah, look, I would say that large companies will have more resources to respond to these issues in a way that is sort of demonstrative and issue social and sustainability reports and do extensive environmental data gathering and whatnot. So I'm not suggesting that there isn't a difference between how early stage and startup companies will show up in the ESG space as compared to Barrick or a Tech or one of the major banks. Obviously, that's true. But I do think it's an issue that everyone can take account of and may become very important for startups, particularly if you get into an unfortunate situation where you're needing money and the particular product or service that you're offering sort of becomes or resonates with an issue that is in the front pages, right? Like that's the concern. So I think it is useful for startups to think about, how do I do this? Well, maybe you build it into your planning process, you build it into an individual who will look at one issue or two issues, and probably you want to start with the shadow side of the business proposition that you're exploring, right? So if you're doing something that touches on personal data, make sure you really understand privacy and where those debates are heading, not only in the legislation, but publicly, and where those might be in 2 to 5 years. That's just common sense, right? And then the idea is, how can we build out from there? If your technology uses a lot of energy, how do we talk about the energy use? What energy does the product save for others? And then, being conscious of that, you can start building that into your story for your customers, and as well as for your investors.
Right. Question. I was thinking, we saw, as I mentioned earlier, where this came from. So this was really came out of some of the initial movements on the clean tech space, which I wasn't actually even quite sure what clean tech is, because it's just a broad-based term, something. Now, where do you see this actually all going? Like, because obviously, paraphrasing somebody that was pretty smart, where is this puck going?
I know the climate space best, right? So in terms, I think that is going to continue to grow tremendously, especially with the kind of funding that you see out of the Inflation Reduction Act of 2022 that just passed in the US, where there really are just tremendous transformative amounts of cash getting funneled into a whole range of climate related technologies, and that will create incredible demand for and money for projects. And if you're part of that supply chain or part of that world, then I think those are tremendous opportunities ahead. Hydrogen will be huge. They're really focusing in on hydrogen, as well as carbon capture and sequestration, as well as solar and wind battery. So there's a whole host of things where I think on the climate space, especially, there will be a long-term 10-year demand for efficient products and technology servicing that space. So that would be one. I think the other place that this is going is more mid-sized companies are going to need to start thinking about ESG factors, including private companies. You're seeing a trend, not with all private equity companies for sure, but increasing numbers of private equity companies are looking at this as well. And so not only the large publicly listed companies, but some of the private substantial mid-range companies were going to need to start looking at this. And they will not have the kind of resources that a large company has. And so there may well be opportunities for startups and mid-sized, and sort of technology companies to be looking at data management reporting, and there will be lots of pain points for those companies, which I think creates a lot of opportunity for companies. And then the other space where I really see this going is actually in the financial sector and financial innovation. This isn't my story. I'm stealing this from someone, but I find it very motivating in my own work, is that, we remember the Model T as this great innovation in business process. But when it came on the market, Ford wasn't able to sell a lot of them because they were demanding full price put all your money down. And it wasn't until the invention of the car loan several years later that the automobile transformation really took off. So I'm kind of expecting some things that we can't even see yet happening in the financial sector to start saying, how do we make it possible to invest in some of these exciting opportunities now and pay them off into the future. So I'm kind of keeping my eye on the financial sector as well. So those would be three things where I think ESG is kind of heading. I don't think it's going to disappear. And so in terms of business opportunities, that's where I'd see some areas to focus on.
Right. Because actually we've seen in some of the press about how ESG maybe as a name, or it may be on the way out. Like we see these changes in how things are described. Now, the underlying thought process and investments, I continue to see they will go. This is not going away. This is truly becoming mainstream, and it probably, from a governance perspective, for all of our companies, it behooves them to make sure that they're aware and are putting in practices that disciplines that are associated with making sure they can take as great advantage of it. You touched on some of the financial and the capital flows. Could you dig into a little bit? Like, we don't have special structures for companies that address environmental in Canada. And we do know that in the US we're seeing certain things from like B Corps and so forth. They are there. What's your thoughts on some of this? Does it help the companies to change where they're located or how they structure themselves, or is it really, should they just be focused on executing on their underlying business and don't worry about those types of things?
So, my perspective, and I'm not sure I have any kind of special position on this. I've advised some companies around whether they should register as B Corps, whether they should adopt some of the, for example, the community contribution company status in BC, where sort of these special statuses. And I've advised some co-ops and whatnot. And my view is that there's that's sort of a false area to focus on. The corporate structure at that kind of coarse-grained level and the kind of B Corp issues are not where the real issues lie. B Corps themselves were developed to address a particular problem that they perceived as a problem in US corporate law. We don't have that issue in terms of there being law around whether boards can take into account more than profit maximization for shareholders. In fact, the law in Canada is that they have to, and that's getting written into various corporate statutes. So I don't think this is that kind of corporate form issue should be a driver. It feels to me like it's a bit of a tail wagging the dog kind of situation. If your company is committed to a technology that's making a difference, or your company has a culture, or the founders have attitudes or approaches or commitments that they want to translate and embed in their articles, sure, why not? That's fine. That's a good thing. But it shouldn't, no one should be expecting those kind of corporate form issues to be as transformative as the other things that we've talked about. There are special circumstances where it can be important in terms of what your funder base is. And I think for some, it's useful to have that built-in kind of network effect where you can start dealing with other B Corps and whatnot. That might be attractive if you're in a sector of the market where that creates a marketing network for you. But no, that doesn't feel to me to be the priority in this area.
That also seems more limiting because, as you said, in Canada, just with the way our governance is, we do not look after just the shareholders. We have to look after all of the stakeholders, and that ultimately is the role of management and the board. We're seeing a little bit of controversy around ESG, especially in the US. Any thoughts on that, and what's shaping your views with respect to how you should be addressing ESG?
Yeah, I'm following this pretty closely, as you can imagine, especially since we're advising some companies on ESG matters and they have US-based operations. I'm seeing two types of things happening, and they're kind of getting conflated. And so on the one hand, you have ESG getting wrapped up into the kind of highly polarized culture war politics in the US, where the GOP is declaring itself against woke capitalism, and in fact, some state level, state secretaries are well, the legislatures are passing, state houses are passing laws, and then they're getting implemented where they're saying we will deny you the opportunity to do business with the state, financings, bond issuance, all that kind of stuff, managing pension funds, if you are boycotting oil and gas companies, is an example, or other companies that are sectors that are in the state. That's something that is coming up more and more. And then you also have, as a separate stream, people who are saying that ESG ratings and ranking systems are kind of broken and focus on the wrong things. So Elon Musk talked a lot about ESG ratings when Tesla was dropped from one of the main sustainability indexes, but his argument wasn't that ESG was bad so much as saying ESG should focus solely on the impact that companies have on the world, and Tesla is having a lot of impact on the world. Now, I don't think CEOs get to pick and choose the performance metrics that people apply to them. And so they can try to shape that conversation. There are lots of people who want more focus on impact, but those are not the same people who are against woke capitalism. They're actually further to the left, saying we should be focused. So there's a bit of a pincer movement is what I'm trying to say, where on the one hand, on the left, people are saying, don't focus on impacts on company, don't do that risk mitigating business stuff, Kai, that you focus on, forget all that. We should just be focusing on impact on the environment. And from the right, you're getting people say, don't do anything. Don't focus on any of this. Go back to the Milton Friedman model. So look, I think that between those two, you get 90% there by being very cautious, deliberate, and focusing on that risk mitigating angle. I don't think divestment campaigns are a great way to influence companies. And so I would just say, try to strike the middle ground, hold to the middle ground, and it's going to be a little bit of a bumpy ride for the next few years on both ends. But I think that argument still holds, that it is in shareholders' interest and the company's interest to focus on changing rules of the game and changing preferences of customers and employees, and that is profit maximizing for the company, and companies should do that.
Got a question here from the audience, is that what's your thoughts with respect to the risks and opportunities associated with US SEC's climate disclosure rules that were just published?
Yeah, so, and we have something similar in Canada. So more people should be focused on the CSA, the Canadian Securities Administrators proposals that were released earlier than the SEC climate disclosure rule, and are being considered now. Look, I think there are obviously some risks in the sense that many more companies are going to spend time and money on these disclosures if they become mandatory. Personally, I think companies are better off with an intelligent mandatory disclosure system in the long term than half the companies saying nothing, and then the companies that are investing money in this and doing it right having others say things that don't make sense, and then there's no point to having spent all that money on doing it right. So I understand that there are, and I really appreciate in the short term and medium term, and I think companies need to really focus on this because people are not addressing it fast enough. There will be real burdens to getting up to speed on what these disclosures require. But I think once that gets settled out and people have their carbon accountants sitting with them right beside their financial accountants, and they can publish these in relatively straightforward ways, then I think that will be a better place, not only for ESG investors or special interest groups, but for the companies themselves, because people can make distinctions. And if you are one of the companies that are investing in energy efficiency or carbon or GHG emission reduction, then you'll get the upside benefit from that. So I'm kind of positive on it. The one thing I would say is there is a risk in the differences between the Canadian rules and the SEC rules. And so companies that have exposure to both will want to track very closely whether disclosing according to the Canadian rules will be treated as equivalent or will be given equivalency for US purposes. That was one of the questions that the SEC was consulting on. And I haven't heard much as to where they're going on that.
Okay. We're going to go back to the B Corp thing for just a second, because we did get a question on this, somebody, and I think that there's real confusion potentially about Canadian corporate structures versus US corporate structures. Where do you set up? We got pressure from investors to say, you need to move to the US for access to capital, where other ones are saying you absolutely don't need to do that. And I'm with the latter on that part. But when you look at this whole B Corp situation, is that, and this is coming from one of the experts in the audience that says, is there an alternative to the blueprint for the B Corp? Or should this be a case where we deal with it as a Canadian company through the governments and disclosure with respect to this? Thoughts on that?
Yeah, so look, I think my comments may have come across as anti-B Corp when what I was trying to say was I'm not convinced that B Corp is the best or only model. So I think it's a good question as to what else is out there. Certainly B Corps are appropriate if you're doing a lot of work in the US. They're appropriate if you want to take advantage of, as I said, that kind of network effect, because I know B Corp is very good at connecting their members. And so that can be very positive, a very positive advantage. But I do think there are alternate models, both statutory sort of models, but it's just also can be that purpose-driven organizations can be very clear about their purposes. And you can write that into your articles without necessarily joining an organization that screens for it. So I think there, as I say, there's niche parts of the market where B Corp and others like it can be very effective. I just don't think it's the only model in Canada. And I'm not convinced that any organized model is really required if a company is heading in a direction that is going to attract capital and employees and customers, right? Like if you have a purpose-driven organization, I don't know that or at least I haven't seen the data that would say that being a member of a recognized sort of accountability body is more important than just having those commitments. Does that make sense?
Yeah,
James?
no, that totally makes sense to me. Like the concern that I'd always have in that is, if you go down that path, yes, you become part of that group, but there's a big risk that you limit everybody else that's not their thesis. And so those investors now are not going to put capital at it. So you're basically picking a side, whereas opposed to saying, if you're a Canadian corp that has to look after all of those interests and you're public about what you're doing and you are making the disclosures, you could actually cover it in the same way. Now, there's a great question here, because it's something you and I had talked about. I did talk to a fund, a major PE fund, and asked them about how does ESG fit into their investment decision process. I won't tell you who it is because that would not be fair, and they deny it anyways. But they actually said that, and trust me, like they have ESG plastered all over everything, all over websites, all over this. And then when I asked the specific question, how does it impact your actual investment decision? It was like, well, it doesn't. So this question comes to us. What's the way they said it? Because what special place do you have for those that are greenwashers or purpose washers, and how, and maybe this gives some thoughts as to what will those things get dealt with over time, or is just greenwashing going to be part of our, you just need to be aware of it?
Yeah, so maybe I can take sort of, because I think there are two different issues that you're addressing there. One is, how does ESG matter if portfolio managers tell you that it doesn't matter, right? Like that's an issue. And then the second question is about greenwashing, and it's kind of related, but there are other things I want to say about that. The thing I would say about the first one is just, I think we need to be careful about what our mental model is of making a difference, right? Because there's one mental model of how ESG makes a difference, which is, I was going to choose this, and but for the ESG factor, now I'm looking at this, right? And I think that's probably what the portfolio manager, the partner in that you were talking to was referring to. I don't look at that stuff. I look at the investment thesis. I look at the long-term prospects of the company and all that. But ESG still has an influence. It kind of has what I would call like an agenda setting power rather than a decision making power. And so it is impacting what large companies talk about with analysts. It is talking about, it is impacting strategy. I think it probably does impact even what that hard-nosed portfolio, the hard-nosed partner, I should say, if it was a private, might be thinking of in terms of future trends, but it's called something else, right? Like it's called regulatory or social risk or something like that. It doesn't come up as a decision factor, but is kind of built in to a lot of the other estimates and cash flow estimates or consumer acceptance estimates and whatnot. And it does get factored in. So I would be a little suspicious. Well, I'm not suspicious. I'm sure they don't think of it as a separate factor, but it may be having an influence, even though you hear people saying it doesn't matter to me as a separate factor at the point of decision. It's just a softer and more pervasive influence. On the greenwashing, look, I'll say something quite radical, and then people can cast stones in the comments, I guess. But I think there is less greenwashing than people think there is. I think greenwashing covers a multitude of sins. We talk about greenwashing has many different meanings, right? So there's the kind of greenwashing which is, I don't agree with your policy preferences. There's the kind of greenwashing where I think company X should be doing more faster, and I would do things differently. And it's greenwashing to say that companies are solving a problem when they're clearly not appreciating the scale and the speed with which they have to address climate change, for example, right? There's greenwashing that gets thrown around in terms of saying companies, the capitalist system is intrinsically flawed and corrupt, and therefore anything individual companies say is terrible, right? So all I'm saying is, if you look at the narrow focus of greenwashing, the narrow sort of, you are saying things out, you are misleading the market. You are saying things out into the world which aren't true. Yes, it's a problem. Yes, it happens. But when I do a lot of sort of helping clients with product launches that will have a social component to it or an environmental component to it, helping them walk through the greenwashing issue. How can we mitigate the risk of having allegations of greenwashing raised against us? And these are very complicated and often quite factually complicated questions, like what is the actual product? How is the linkage back to the social or the environmental goal that you're trying to obtain? What kind of disclosure are you going to have? What kind of supporting documentation and testing are you going to have? So companies that are trying to do this are very conscious of that level of greenwashing. It's very complex and fact specific, and their mistakes can be made, and reasonable people can disagree as to whether folks are putting out the true information. But companies that, at least that are working with me, are very conscious of that risk and spending a lot of money on lawyers trying to make sure that they're meeting at least the legal standard of not making false claims to the market on environmental and social claims. So I don't know if that answers the question.
No, I think so. When one of the things that I've seen is some of the your point is actually really well taken. Some of this stuff is actually really hard to measure and really hard to actually assess where you're at, because now you're even getting to the point where proxy firms, Glass Lewis, will actually will rate companies on ESG. And if you're having trouble figuring out your rating with respect to ESG, well, they have an advisory service that will actually analyze you from an ESG perspective. Not sure how we handle I'm sure they're saying there's no conflict between that, but that's as we side the point. What I'd be really interested in getting your thoughts for the companies that we have and we're working with. What will be from your perspective, what are key risks and key questions that they should have in their back of their mind when they're looking at this relative to their entire operation? So thoughts on that?
Sure. Well, I think probably the first thing is just to make sure that you are thinking through and monitoring material, social, and environmental and governance risks related to your product or service. I think that's almost 90% of the message, right? Is it is too easy to get focused on the narrow metrics and then to get sort of a blinker effect where you're not, or a tunnel vision effect where you got a very narrow set of KPIs or other metrics that you're trying to meet, none of which are focused on the broader market acceptability of your product or service. And then you just get to a point where terms of the discussion change and all of a sudden people are judging you by something brand new. Whereas if 2 or 3 years before you had been monitoring issues and just building it it's far easier to build something into your product or service from the start than to try and jury rig something at the back end, right? So I think that's really the question, is just taking a beat or having someone or looking for an external advisor who can help you can help you monitor those material changes of social expectations, and then ask yourself, as you're iterating on your product and service, how can I build in that? How can I take advantage of that at a time when it makes sense and is profit enhancing or low cost? And if you keep an eye on it, then you can build it in when it isn't a conflict between ESG and profit maximization, rather than leaving it to the day when, oh my gosh, now we have to reinvent the privacy details on our service because people are caring about that.
And do you see that as the greatest risk facing our companies? They're just not aware and not having this in top of mind? Because, you know, when you look at changes and how they take place in the world, you see, you know, you don't know who's going to influence and who's going to drive some of these changes in behaviors. We're seeing this from in entire sectors, and you're seeing it in automotive, you're seeing it in, and so being aware is probably your best defense, would you say?
Well, I mean, I guess what I was sort of trying to, I was just talking about one element, but I think it's not the greatest risk, but a failure to be aware and then a failure to act on things you learn would, I think, in the ESG space is kind of sums up the risk profile, right? Sums up the profile of the companies that run into trouble because they're not forthright on issues or concerns which catch them off guard. The wind shifts and all of a sudden they've got to shift with it. And if they had been aware earlier, they could have been prepared. So yeah, I'm not trying to say I like that. I'm giving you a generic thing that kind of sums it all up. And part of why I guess I'm resisting a little bit saying what's the biggest risk is I think that's part of the problem where people say, well, okay, everyone's talking about climate change right now, so I've got to talk about climate change. Everyone's talking about diversity, equity, and inclusion. I've got to talk about diversity, equity, inclusion. And all of a sudden you have a 70-page social sustainability report and you only have a few people to make that happen. Like that doesn't help anybody. So I would be less driven. Obviously, those are important issues. I work in them. I'm not saying that climate isn't important and diversity, equity, and inclusion isn't important. But the question is, what's the biggest issue for your company? And then how do I address that in a business-like way, in a managerial way? And how do I report out on it in a forthright way that doesn't get involved in greenwashing, or I'm not just sweeping things under the cover, I'm being honest about my performance? And I think that's sort of the holy grail at any scale of corporation.
Right. Now, are you seeing this discussion? Where is this discussion taking place in corporates? Is it taking place at the C-suite level? Is it taking place at the board level? Who's actually paying attention, or is it all of the above? And how does that
really
impact
a broad? I think it's what you would expect, James. It's across the full range. Larger companies that I work with that are doing well in this have a very well structured system where, you know, they've got management folks at a senior level looking at it. Issues get escalated to the board level when needed. You have people on the board able to speak to things, and it's part of the culture. So if that's the ideal, and then there can be a very great number of variations on that, I think there is definitely a move towards more senior folks being involved in this. And where the companies that I see doing this best are ones that have that kind of full meal picture, right? Full meal deal approach, where it's like right from the top to the bottom, there is an element of ESG, not necessarily dominating your job or taking away from other profit-making aspects of your job, but is just part of the way the company works.
Right. And we're seeing that, like we see it in the press with, you know, there was the Suncor's issues where there's change in management because obviously impacts on the S side, right?
Yeah.
It wasn't an E side, it was S side, and obviously, as you said, G covers both of them.
Yeah.
So this is definitely top of mind for in the large corporates that I'm seeing. They just cannot accept this. And when you get activist investors, are you seeing activist investors playing in this sector? So where you kind of curious, where if you had a company that's too focused on ESG, I don't know if you can be, but let's just say hypothetically you're sacrificing profit. Are you seeing activist investors coming in and playing? I know that wouldn't impact our earlier stage companies, but it could impact acquisitions and exit strategies for our companies.
Yeah, definitely. And interestingly, I think we've had a shift away, like maybe 5 to 10 years ago, you were having activist investors or individual investors who were active, not the full activist investor kind of thing that you're thinking of, but definitely shift management when managers were maybe ahead of the curve on climate. For example, there's some cases where people who are trying to split up companies or trying to reorient energy companies towards renewable energy got shuffled on. This is 5 to 10 years ago, whereas now I think the trend is the other way. Now the trend is activist investors, and the Suncor example is a good example of that, where the reason that was the right move was because in response to pressure from investors, the company had made public commitments, and then were unable to keep those commitments. So it is kind of this broader sectoral change where I think the activism and concerns about activist investors are moving. But I would stress, I don't see a lot of that coming purely in that's disconnected from the profit motive as well, right? Like even that was sort of saying, well, that's a management failure if you promise to do something and then couldn't achieve it. What else does that signal to us about the company, rather than being like that pure play ESG purpose-driven thing that we were talking about earlier. This is
right. Then we're going to run out of time, but I do want to ask you something else, because obviously we're talking about capital flows, we're talking about management, governance, and so forth, and obviously really appreciate the time that you spend on this. All our companies are eventually looking to a liquidity event. We want to be able to get positioned to sell. Okay, so we do all of this. How do you see what they should do with respect to this to make sure they're maximizing value for the company, not just on the raises, but on the exit? Is there something that is different that they should be aware of in that regard?
Yeah, I don't think there's anything radically different other than, as I said before, being aware that this may be an issue for some of the folks who may be involved in that exit, right? And to the extent that you have either a business or a part of your business, an impact on the world, or a value or a purpose or a commitment, make sure you're able to tell that story in a credible way that is connected to the business thesis, right? And is not just an add-on, or you're not just being quiet about it. You actually address those issues. And I think in the startup and early stage company context, that can be all that you need to be the difference, right, between another option that investor has where they're not taking those issues seriously, and in the due diligence process someone discovers, oh wait a minute, they've never thought about their privacy issues. That's how can we invest in that, right? Those are real risks on exit where companies can do well for themselves by addressing them at the earliest stage that it makes sense.
Kai, thank you so much for the time. This has been super interesting and important. I think this is key to all of our companies that they must actually keep this in mind. So I thank you for your time. Appreciate it. For our audience, if they need to talk to you, I'm sure you can reach out to you directly, and
Absolutely.
you can help them with their ESG and making sure they're set up for not just now, but for ultimately the exit. Stephen, back to you.
All right, everybody, thank you for that. As James said, thank you, Kai, for your time today, your expertise and your views. James, is always a pleasure listening. You kind of navigate that for all those who ask some questions. Thank you for that. It's great that we get to interact and see what you care about most on this topic. Again, it is, I would say, an evolving space, and it's kind of hard to get right. As Kai sort of said, there's multiple ways to go about it, and ultimately we want to see your wonderful purpose-driven businesses take the right path towards having a huge impact on the world. We'll be back next month with another session of this. Look forward to that in your email inboxes. Don't forget to mention to folks that you think might qualify to nominate themselves or nominate for them into the Foresight 50. And of course, if you know any small startup businesses that might need some help, our applications are open for the fall cohort. Have a great day. I'll see you all soon.